welcome to the stock-specific class here for Thursday, December the 15th. As always, if you have any questions during the week or any questions that I don't get to here in the live class, make sure you send those to jerry@traderspro.com. I also want to make you aware that there's a lot of trading videos on our YouTube channel. If you go to YouTube and type in Traders Pro, subscribe to the Traders Pro channel, you get access to those recordings and a lot of training. I did a training video on just about anything I could possibly think of to teach. So there's a lot of stuff there. I don't know how much of that is still posted, but I know a lot of the core stuff, the most important stuff, kind of the basic philosophy stuff that I use. Those videos are there for you to review if you have time. So, all right. Obviously, big move down today. If you've been following me for a while, you know this is not surprising at all. In fact, we're just waiting. The charts were saying we're going to decline. The price action was saying we're going to decline. And finally, we're starting to get the decline. Again, this illustrates, though, basically the limit of what we can do as traders. And to recognize that the market is always going to be the market. You can never know exactly what the market is going to do. Now, you might say, well, wait a second. You just said we knew this was coming and it came. Isn't it that we knew exactly what was going to happen next? Of course not. And especially if you go back and review just the last week. And how many times did I come on and say, man, this is what should happen. This is what the charts are saying should happen. And yet you get that CPR report, we open up big. Luckily, we reversed that right away because I was really nervous. Like I mentioned on Tuesday when that CPR report came out, I'm like, this doesn't make any sense at all based on what we've been analyzing, what we've been looking at. I've been doing this for 24 years. That's a lot of experience. I recognize some things that if you're just starting out in trading, you might not be able to recognize. I try to help you with your learning curve to speed it up so you don't have to spend 24 years to get to where I'm at right now. But as much as experience as that is, again, the market will still throw you little curves here to make you question what you're looking at. And there are times when I'm pretty confident that the market's going to do something that doesn't end up doing it. And you have to be able to pivot and go with what the trend is telling you. The market will always, for every trader out there, will always do something that causes them to question whether their analysis was correct or whether they're on the right track. And now, I think it's important, though, to continue to emphasize what we're doing as traders. We are trend traders. We are looking at, we could care less what the noise is out there, what the chatter is, really what the CPR report says, what the Fed decides to do. What matters is what is the market actually doing. I got a lot of questions yesterday, people asking me what I thought the Fed was going to do and how the market would react. And then as Chairman Powell was having his news conference, I got a couple emails from people saying, well, is this sounding like the market's going to go up or the market's going to go down? And my response was, man, I gave up on that a long time ago, trying to figure out the tone of Chairman Powell's voice when he's doing the news conference. Does that mean he's bullish or bearish? Or boy, he wore a blue-colored tie, so that must mean he's bullish, or I don't know, whatever. It gets ridiculous. I don't care. It's what is the market reaction to what he's saying or what they're doing, what number comes out, what is the market reaction? and again, no matter how long you do this, you're never going to know exactly where the market's going to go, but you can see where the trend is, and as long as you can recognize how to see the trend, then you're going to be on the right side of most of your trades, and that's all you can ask for. You're going to be able to make more money than you lose over time. Now, another thing I think is kind of funny, because I hear it all the time in bull markets, or when the Fed is lowering interest rates. When Fed lowers interest rates, it's always bullish for the market, and everyone comes out and says, "Don't fight the Fed. Don't fight the Fed. The Fed is throwing money out there. It's going to make its way into the markets, and it's going to cause the markets to go up." And they're absolutely right. You don't fight the Fed, and when the Fed is pouring money into the economy, it's going to find its way into the markets. It's going to cause stocks to go up. But these same people, when it's the opposite, suddenly fight the Fed. As I've been saying for weeks, Chairman Powell needs the economy to go into recession, and more importantly, needs people to lose their jobs. They need the unemployment rate to go up. Because we got to stop all the spending that's causing the inflation. It was completely idiotic. I heard in this, I can't remember when it was a while back, during the height of the inflation. I think it was in the summer, in the height of the inflation, in California. What the California government decided to do is to help the people with inflation, that we're going to give you a stimulus, and we're going to give you some money to help you get through inflation. Do these people understand economics? That's making it worse. So Chairman Powell is saying, I'm going to slow this thing down because I know how to get out of a recession. The Fed does it all the time. They know how to and they can do it. It's very difficult to choke off inflation. That's always scared the Fed. It's scared people that understand how inflation can get out of control if you don't stomp it out. And so that is what he is doing. And so you can't say don't fight the Fed when they're loosening, and say, oh, fight the Fed when they're tightening, or tell the Fed say the Fed doesn't know what they're talking about. That's another thing. They've been saying, oh, the Fed is wrong, and they're going to be wrong, and they might be wrong. Okay. But you don't fight the Fed. Even if they're wrong, you don't fight the Fed, and that's I think the market is finally realizing that right now, and it's one of the reasons why we're starting to see the selling that we're seeing today. Now we'll look at the charts here in just a second, but I wanted to start off with that because it bugs me, because I hear it all the time, when rates are being lowered. And then I hear these same people saying the Fed is wrong, and they're fighting the Fed when the opposite is happening. And it just makes that saying ridiculous if you're not going to follow it both ways, So we'll take a look then at could this get worse, or how much worse could it get? We'll take a look at that here in a second. But going through the direction alerts, now these are going to update overnight, so they're not taking into account today's move. So momentum, in other words, is in the middle right here. It's probably going to move over to this side, or maybe even to the sell range when the updates. But again, it's not overbought or oversold. So if you think, boy, we moved down a lot today, is this going to bottom out here? We're going to go higher. These indicators aren't saying we're anywhere near an extreme oversold condition yet. So yeah, we could drop down a lot farther from here, based off of overbought, oversold conditions. Breadth is way a ways from being oversold. It was in that extreme overbought area just recently. Again, now this is going to update and move over tonight. It'll move over to the left a little bit. And then look at this sentiment. Now this will probably move off of the far right side of that, but if you think we've had this much selling, and we're not even seeing fear in the market yet. Now, we're not talking panic. We're not even seeing fear, and we'll see that in the VIX indicator here in a second too. Now, if you want to know when it would move outside of that extreme risk right here, you can look at this down here. When it gets above this red line, that's when it moves into that extreme reversal risk. And here's where it's at right now. So, I mean, it's not going to get out of that extreme reversal risk very quickly, or at least it could. Well, it could. You start to see the fear spike up, and fear can spike up pretty quickly in the market. It'll move down below there. But again, this is saying that the selling could just be getting started. And keep in mind too, I talked about this on Tuesday, that again, most people believe that, and I strongly believe that we're going to have a recession next year. And the market has not factored that in yet. They haven't traded that yet. Part of the reason why we've been kind of back and forth on the chart is that they're seeing conflicting data. They're seeing some signals that might indicate it could be a soft landing, and some that could be inflationary. And I think from here on out, we're going to start to see more evidence of that. The January jobs report, that first Friday in January, will be important to see because again, is employment, until we start to see that employment rate going up, and it's not just barely ticking up, it needs to go up a decent amount to make sure that spending is slowing down. Then we know that Chairman Powell is going to keep the foot on the brakes, so to speak. I guess that's the better. I can't remember if it's the foot on the gas or on the brakes, one of the two, however you want to look at it. But he's not taking his foot off of anything yet. And we don't want to, and until he does. The thing I'm pointing out here is if you have a hard time believing that it could get worse than what we're seeing today, what I'm trying to say is we're just getting started. The market has not factored in the stuff that's coming. And one thing I've often said, I try to stay on the side of probabilities as much as I can, because that makes sense. It's like, if something has a 80% chance of working out, I'd rather be betting on that than a 20% chance of working out, right? That's just common sense. Remember, gamblers do the opposite. Gamblers look at the low probability, high reward situation. Oh, there's a 20% chance that I'm going to turn my $2,000 into $10,000. Okay, let's bet that. The smarter investors will look at, hey, I'll take the 80% chance that I'm going to make, $1,000 or something like that, as opposed to the small chance I'll make the bigger amount. So, but the Fed never orchestrates a soft landing. And even the times that they've claimed that they'll say it's relatively soft, it really wasn't that soft. So when people are betting on the Fed to orchestrate a soft landing, I'm saying, well, when have they ever done it before? And you can't find much evidence of that. Like I said, even the times they'll point to they were pretty rocky. It didn't look too soft to me. If I were on the plane landing, that would have been a very soft landing. It's not like the normal touchdown at the airport that you experience in your flight. So anyway, let's move on to. I want to get through the market update part pretty quick, because I spent most of that time on Tuesday, and I don't want to just repeat everything I talked about on Tuesday. Buy-sell ratios, again, not showing any extreme. This sentiment indicator is, again, it's going to move down. It's right in the middle, not showing any extreme overbought or oversold. All right, let's get to the chart. and we're kind of sitting right now in a pretty critical area right here. The support area this is the next support area, and I'm really interested to see how we close today. It's about 389 to about 388 to 389. Now, part of this, about 388 right here is where we opened. This is when that CPI report came out back in November. We closed down here. We had this big gap up to this point, and we took off. So there were buyers at the open that pushed things higher at that point. There were buyers right here that pushed things up a little bit. Now, there were sellers in this area right into here. There's a little bit of resistance right there. Extend this line out. You've got resistance back here, support here, resistance here, resistance here. That gap up day right there, a little bit of support there. So this is, and we're sitting right at this area here. I don't think that's going to hold. Typically, when you come down to a support area and you close at that support area at the lows of the day, you're usually going to break that support area. It's usually not going to hold. Now, if we come off the lows and we end up with one of these tails, like yesterday, we were traded down here, and by the end of the day, we came up off the lows right there. If the same thing happens, then, you could possibly get a little bit of a bounce out of that. By the way, if we break this, the next area is down here. I mean, there's a little bit down around in here, a little bit here, but we're heading down into here. If we break this support area, we're heading down to the previous bottom there in October, in my opinion. Now, I don't know that it'll go straight there. Typically, you're not going to, even on some of these bigger moves down, you had a couple days where it tried to bounce here. You tried to bounce for about 4 days and then continue lower. It'll stair step its way down. That's typically how it does it. But again, you can see that we broke into a lower low today. So even if we do come off the lows today, we have broken to a lower low. These last few days are looking impulsive down from that open on the CPI report. By the way, you say, okay, we had the CPI report, we had the Fed meeting, and we had, you could say, the retail sales data today, although it was kind of funny that the market's having the biggest reaction on the retail sales. If you think that now the market is obsessed with the retail sales data, no, it's not. It's just that was building. It wasn't rallying off of the CPI. It wasn't rallying off of the Fed, and then you get that retail sales number. Drove it to that lower low. This has a whole impulsive look down. So what would you, if you want to confirm, let's say the market does try to rally tomorrow, what would confirm that we're still going lower? Well, if it tries to rally, it would be more sluggish, more choppy. It would feel like it's struggling to rally. So you might see a couple days where it just kind of barely moves higher, and then it starts its next move down. That's kind of what you would look to see. You wouldn't want to see it. Usually, you wouldn't want to see it close above the high of the previous day. So on these, if it does try to rally, you wouldn't want to close above today's high. But that's what I would be looking for. Now, if we're down again tomorrow, and this happens a lot when you get a sell-off on a Thursday, it tends to carry over to the Friday. Remember the saying I always tell you, and this is important, it's another thing that'll help keep you on the right side of trades a lot of times, is that the market usually doesn't bottom on a Friday. So if you have a big down day tomorrow, or even just a decent down day after the selling we've had this week, then it's likely to at least carry over to at least the open on Monday. You'll get a gap down on Monday, or it'll continue to sell off on Monday. It usually doesn't bottom on a Friday. So that's another thing to kind of pay attention to. Now, tomorrow, what's unique about tomorrow is it's a quadruple witching expiration for options. There's all these different types of options that are expiring. and it can create some volatility in and of itself. And what you could see is the market going back and forth throughout the day as it tries to, if you got people if you've traded options before and your options expiring, you tend to be very emotional. You're either, if you're trying to squeeze out a little bit extra profit on it and then it starts to go against you and you're losing your profit, you tend to get out. You get scared to get out and keep your gains. If your profits start to turn into a loss, you tend to get out to keep it from being a bigger loss. And traders know that, so they move the prices back and forth on those option expiration days. There tends to be a lot of volume and a lot of misdirection. So if you see something early in the trading day, don't assume, like if it tries to rally, don't assume that the market's going to rally the rest of the day, or it could just be trying to shake out people that hold put options, and then it'll drop and then shake out people that are holding call options with that expiration tomorrow, and you tend to get that back and forth. You also have big institutional traders that are exercising options. They're buying the shares that they have the right to buy at a certain price, or shorting the shares with the put options that they have the right to do at that strike price. So expect some volatility tomorrow and some back and forth. It's usually on those quadruple witching expiration days. I try not to make too many trading decisions, do too many new trade entries into those days, because like I said, you can't always trust what you're seeing in the price action. All right. And keep in mind too, again, for those, there might be some new people here. What we're looking at too is that we declined off of this trend line. What made the drop a lot more obvious was every time we rally up to this trend line, and it did break above it, but remember that was where it opened up here, and then by the end of the day, it closed back below it on that CPI report day on Tuesday. We looked at that on Tuesday. To the exact point, it reversed, and each time it did that, it took out the previous low. It took out that previous low. This one, it took out that previous low. And so we don't know what's going to happen this time, but we're assuming it's going to take out that low as well. Now, it's also important to point out that at some point in time, it's going to break that trend line, right? It's not going to do that forever, but I go back to something I've talked about a number of times. I know I might have some new people, but major market bottoms, all the ones that I've had experience with over my trading career, have had a panic sell-off at some point during that decline. And during this decline that started in January of this year, and it's been going on the whole year, we never had a panic sell-off. We had big sell-offs. They like today's a good example. A big down day, but it's not panicky. Maybe for some people, maybe for some individual people, it's panicky. But for the market as a whole, the gauge that we look at for fear, it's not even at fear yet. So you can't even call it panic. How can you recognize a panic sell-off? I'm going to show you here in just a second what I'm looking for. When we get to the VIX, I'll show you what I'm looking for there. But until we get that, I'm assuming every time we rally up to that line that we're going to keep going lower. If we do get a panic sell-off, then I would assume that as we rally up to that line again, let me go back to the SPYs here. If we rally back up to this line, we're going to end up breaking above it. That's when I would bet that we'll break above it, as we get a panic sell-off. And then when we come back up into here, I would assume that we're going to break above it. Not to mention the fact that bear markets tend to be shorter. Bull markets can last for years. Bear markets, if you get a year-long bear market, that's usually pretty rare. Although they do you do have major ones where it gets to be that long. We've already kind of been, officially we kind of hit a bear market status. Somewhere in the decline. It was somewhere in the spring, I think we hit it. And so but it's still going on. It's still acting like a bear market. And really, that's kind of the last thing I'm looking for, is to get that panic sell-off. Not that it bottoms on a panic sell-off. It can still go lower from that, but then I can start to at least feel I could get more bullish. And if we break above resistance levels, I'll trust that breakout a lot more, because I know it's kind of fulfilled that box to check off that you look for on those market bottoms. All right. Qs, I told you how the Qs tend to be leading, right? They tend to be the leading indicator. That always bugged me because the Dow was leading the way. Dow was a clear uptrend. That was a clear uptrend right there. But again, notice how the Dow is now broken to a lower low. And that bearish reversal on Tuesday, and it broke to a lower low. We should see, if the Nasdaq is the leadership, it should be leading the way down, and so far it is, and it should be the first one to break that October low, and it probably will be. But I think it's also important to look at the percentage move today. The Qs are down 3.5% compared to the Dow, which is about a little over 2.5%. So there's a greater drop there in the Qs, as you would expect to see. You'd also expect to see the Russell 2000. You're not seeing as big a drop in the Russell, but that's another one that tends to be a little bit more of a leadership, and it'll probably break below its October low before the other indexes do as well, before the S&P and the Dow. Bonds, what I tell you to look for on Tuesday, I said look to see if this looks to be more sideways in this correction, and sure enough, that looks more choppy, more sideways. I would assume that the bonds are going to continue to move higher, acting more like an uptrend now, impulsive. This is more corrective, should have another impulsive move up. And so I think we've transitioned from a downtrend into an uptrend there. Gold down today, but I've liked gold, and I'm still holding the gold mining stock. I talked about the gold mining ETF that we could look to get into with the portfolio. I'm going to wait to see how much it's taken down a little bit with the recent selling, but that's something I'll be looking to get into. I still like the chart of gold. Go back to longer term chart. You can see it's broken. It broke the downtrend line. So this is kind of, it broke that downtrend line, and then now it's kind of stair stepping up. It's acting more like an uptrend. And I've turned a lot more bullish. So if you're looking for something to buy or something that we could be more bullish on, well, when you're expecting big sell-offs, you don't want to be in anything yet, because when you have a big sell-off day, we haven't had a panic sell-off day, but when you do have a panic sell-off day, everything drops. And we are seeing a lot of things drop today, but almost everything just goes down. People just sell everything. They don't even the good stuff they sell. So you don't want to get caught up in that, unless you're okay with that. If you're not looking to you don't care about a good entry or better entry, but you can't get in, and then if the market does have a panic sell-off here, it'd be like, oh man, I am down big and this is painful. And it's like, well, that's just it. Avoid the pain. You have to have a bus stop mentality in your trading. Meaning, if you think that you're everything's a once in a lifetime opportunity. Oh, I got to get in right here. I used to fall for that when I was first starting trading. When someone could come up with a penny stock and they said, this company's going to do this and it's going to revolutionize the world. I remember the first one I got into was a thumbprint technology company that was going to that all you had to do was scan your groceries, put your thumbprint in, and it was tied to your bank account, and it would pay based off of your thumbprint. Now we have that technology now, and it works great. But this company, so I thought, boy, this could be revolutionary. It's only like $3 or something. It's like a $3 stock. Well, then it went bankrupt. It wasn't the one that carried on that technology. And what I should have done is just found the one that is a good, solid company that's doing the same. Wait until they do the same. They get the technology and the company is strong, and then go trade it. And you can make plenty of money on that, trading it from a $30 stock to a $400 stock. So I developed the mentality of let the company prove itself first, and then I can make plenty of money, but it's a safer time to get in when they're in a better situation. They're not piled in tons and tons of debt, and their whole focus isn't to forward the technology, but to manage the debt they have. So that's kind of where it started, where you start to develop just a bus stop mentality, where if you miss the bus, okay, don't panic, don't scream, don't throw a tantrum, sit on the bench. 30 minutes later, another bus is going to come around and you'll be fine. You have to have that same approach with trading. If you miss a trade, I do it all the time. I'll see something, and usually it's because I'll find like 3 or 4 stocks I want to trade. You can see this with the stocks we're going to go over today. One of them might take off, and maybe it was the one you didn't trade, and it has this huge move, and you're like, oh man, I saw that too, and I didn't trade it, and it took off on me. Yeah, we all do that. We're like, oh man, I missed it. I'm not saying you're going to be upset with missing the bus. You got to wait 30 minutes for the next one. But what I'm saying is don't think it's the end of the world. Yeah, you missed it, and you laugh about it and be like, oh man, I missed that one. Get back to work, because you're going to get one eventually that makes the move and makes your money. You just, wait for the next bus. Now we're kind of in a situation right now. We're waiting for the next bull market. Okay, we're in the bear market right now. The smartest thing to do is just sit on our hands and not do a whole lot. Maybe trade some inverse ETFs to make a little bit of money. So those will go up when the market goes down. But we're going to have another bull market at some point in time, and we want to make sure we don't lose all our money now over trading in a bear market to where we can't take advantage of that bull market. All right. Oil. Now, I said to watch oil. I think oil's interesting today. You say, okay, well, it's down a little bit today, but look how much oil is down compared to everything else. When I told you on Tuesday that I felt like oil could be starting to rally, could be looking more bullish, this is confirming that, even though it's down a little bit today. We're down a little bit less than 1%. The way it's holding up, it's off the lows of the day. It's not down very much. It's telling you there are buyers still there. Now, again, maybe it gets crushed tomorrow if the market has a panic sell-off, because everything can drop. That's why I'm not saying go dive back into oil just yet. Let's see how this kind of plays out over the next couple of days. But keep an eye on oil. I think, and I do have a couple stocks I'll go over today with you. By the way, the stocks I'm going to go over today, I'm not going to say get in today. These are ones you're going to want to just kind of keep in your watch list, keep an eye on. I'm going to go over some sectors to start watching. Just be prepared, but these can come down, and they can come down pretty far. If this selling is just getting started, they can come down quite a bit. So we want to wait till we're maybe as a target. Let's wait until the market gets back to those October lows, and then start looking at things that you might want to start getting into, or that you could start to consider getting into. That might be a good, or if it doesn't, the market doesn't decline any further and starts rallying back up. If it breaks, by the way, if we do rally back up, we break above that CPI report high on Tuesday, last Tuesday. That last Tuesday's high is going to be critical. Put a trend line across that. If we don't go down any further, we break above that, you're definitely going to see me turn bullish, because with all the selling we've had the last few days, if we overcome that and break out above it, we're probably going higher in the near term. We're going to probably get that rally into the end of the year. I just don't see, because that'll mean we'll also break out of that trend line, that declining trend line again. And now we won't have our panic sell-off, so I'm not going to fully trust the rally at that point. But you gotta our job as trend traders is to see the trends. Is it acting like it wants to go up? If it is, then I want to be trading that direction. All right. Oil, keep an eye on oil, and there's a couple oil trades I'll look at here today. The dollar, now the dollar was declining yesterday. It started to move lower. We have this big move up today. Now, we haven't gone to a higher high. Here was the last lower high right here. Lower high, lower low. But let's see if the dollar breaks that downtrend. Now, I still think the dollar ultimately is going lower, but what it could be is it's going into a larger correction, maybe a larger bearish ABC pattern, gets up in this area here, and then maybe declines. But the market has been moving opposite of the dollar a lot lately, and so it's not surprising that the market's down big today, and the dollar is up pretty big today. And it's also not surprising that the market was down yesterday, but it wasn't down a ton. Remember, it came off the lows of the day. And look at the dollar. Dollar was down, but not down by a lot. And it was kind of a little bit of an indecision candle on the dollar. So it really is looking at the dollar right now. Now, it's not always going to do that, so I don't want you to say, okay, I'm looking at the dollar every single day because it's going to tell me exactly where the market's going to go. But it is focused on that right now, and so we're going to focus on it right now. Just like we were focused on it was looking at the high yield corporate bonds a few weeks, about a month ago or so. And so we added that into the market update because it was moving almost the same as that high yield corporate bond. Then it kind of stopped really moving with it, I heard less and less people talking about it. And so but then they started focusing on the dollar, and it's kind of been moving opposite of the dollar move. So keep an eye on that. If the dollar rallies up a little bit further, it would probably lead to more selling in the markets. All right, the VIX. Now, again, the VIXY is one you can look at to look at the VIX on the software on TradersPro. If you want to look at the actual VIX indicator, you'll have to pull it up on another charting service. If a free one out there is stockcharts.com. I use it on I actually like that on my phone. They have good charts for a phone. So I actually, but I just use the free version of it. But what they did though, it used to be you could just type in VIX and it would pull up the VIX chart. But just over the last couple of weeks, they changed it. In fact, I typed in VIX and it said it couldn't find the symbol, and I freaked out because I'm like, I love to use this on my phone, and it doesn't cost me anything. And it turned out all they did was change it to where you had to put a $ in front of the VIX. So if you put in $ VIX, this is on stockcharts.com. And again, I don't have any affiliation with them. In fact, Jesse doesn't like me talking about other services, and I understand that. You don't want to work for Coca-Cola and talk about how good Pepsi is or something. But for just pulling up the VIX chart, you can see it for free. That's what you could do. But just make sure you put that $ in front of the VIX. But I can pull it up here on my charting service I use on my computer all the time. In addition to TradersPro, I'll use the Trading View. I like this because I can manipulate the chart a little bit, and I can write on. I have trend lines and moving averages and things like that. So it's just a different way of looking at the chart. The TradersPro is a trend software. It's looking for trends. It's got the algorithms already built in. And so, but if you're looking, if you're wanting to do other types of analysis as well, this is a good one to use. The Trading View is a good one. I just don't like their version on the phone as well, so I use that other one. But you can see the VIX right here. What happened Tuesday? Or Monday, we had I talked about this on Tuesday. The market moved up and the VIX moved up. Whenever the VIX and the market are moving in the same direction, you want to pay attention. In that case, it was probably hedging, buying some protected puts ahead of the Fed or the CPI report. Then we had the Fed meeting, we had the CPI report, and then we had a VIX that was down and the market was down. And then yesterday we had the VIX down and the market down. That's telling you the market wasn't concerned. It wasn't concerned with the selling. Now, normally you'd say, well, isn't that bullish? Yeah, that type of behavior is bullish when the market's already declined. If it's been declining and then the market's down and the VIX is down, you say, oh, market's not worried about it declining any further. That's bullish. When this shows up at a high, we're still at the market high on this rally the last couple months. That's bearish. That's saying the market isn't worried yet. Remember, I told you every time the VIX gets down to 20, we see these big market sell-offs. Yesterday, the market was down and we were at 21. We're almost back down to 20 again. Now, this isn't going to perfectly tell you when the selling was, but did not shock me at all to see the market down big today. And 30 is fear. We're not even at fear yet. We're still ways away from fear. Now, again, I told you, what do you look for if you get that panic sell-off? 40 is a minimum you'd want to see. We never hit 40, as you can see, during all the selling last year. And that's a minimum. Get above 40. We see that, then we'll start at least saying we can check that box off for a market bottom, and we're much closer to market bottom at that point. But VIX is a little bit off the highs of the day today. We'll see kind of how it looks at the close. And the market will probably, if it's going to sell off into the close, it'll probably happen at the top of the hour when I wrap up the class. And especially in that last half hour, you'll probably see it. And it could rally off the lows, but that's usually when you see it start happening, is during that last hour. And almost to the minute, because those algorithmic traders, as soon as the top of the hour hits, if they're selling or buying, they'll start doing it right then a lot of times. All right. Here, I wanted to get to the market update real quick. I'm going to just skip the other ones I usually go through. You can go back and review Tuesday's class to get that. Let's take a look at some trades. First of all, there's some sectors that you need to be aware of, and I actually have a watch list here. Now, I'm not going to keep this up for too long, so you might not be able to write them all down if you want to build a similar watch list. But you can go back on the recording and do that. I'll try to leave it up here for a little bit. But these are sector ETFs. So if you feel like the financial stocks are gonna take off, but you don't know whether you want to own Bank of America or American Express, and you're afraid of picking the wrong one, but you know the whole group should move, then you can trade the whole group by trading the XLF. That's the financial sector. Okay. Now, these ETFs, they don't move as big percentage-wise as the individual stocks. So if you did get into individual stocks and they make the move you're expecting, you'll make more money with those. But they're a little bit safer. They're safer to the extent that, again, let's say you buy or you were going to buy JP Morgan, but you decide to buy Wells Fargo, and then bad news comes out on Wells Fargo, and it goes down, but JP Morgan goes up, and all the other bank stocks go up. then that can be frustrating. And so to minimize that single stock risk, you can just trade the whole group, and that's the attractiveness of this. Now, I don't like to trade ETFs that much, but I like to look, because these can also give you clues as to which sectors as a group are starting to move and take off and look good. So it's not a bad idea to go through these sector ETFs and see which sectors are maybe starting to bottom and move up. It can kind of give you a better idea. And then you can go look at individual stocks within those sectors as well. Now, part of that can be done, like I said, I'll come back to this, going under the sector tab right here. It does the kind of the same thing right here. It'll show you which sectors are moving, and then we look at what individual stocks within the sector, which are the strongest ones within the sector, okay? But again, another way you could do it, or if you wanted to just trade the groups, I just want to trade the oil sector or the energy sector, well, then go trade the XLE. That's the energy sector ETF. We talked about how oil is starting to look like it could rally again, and so now a couple I want to point out that I've noticed lately is the biotech sector. I really like now there's different ones here. You got the XLV, which is the healthcare sector. You've got the IBB, which is the biotech sector, and then the XBI is another biotech sector. And the difference is they have different companies that are the main weight in the sector. They might have Amgen weighted higher than another biotech stock, and so they have some different weightings. But I really like the chart of IBB right here. If we look at a long-term chart of this, you can see it's already had this big decline down. And remember, I like to see, does it look like you're going up the right side of the bowl? We're starting to see, we had lower highs and lower lows through here. Now we had kind of an even high right here, but we had a higher low. And then recently it broke out to a higher high right here, and it's kind of consolidating right now. You also could call this a little bit of a cup with handle formation as well. Now, if it breaks out of this range, it could really take off, and that would probably be the smart thing to do, is wait for that. Zoom in on a 6-month chart, you can see that kind of sideways consolidation. If we do sell off a little bit further, we could see it dip down a little bit further here. That's why I'm saying you'll probably get a better entry point a little bit later. But that's one to keep an eye on. By the way, if you build a watch list of these sectors, and you've got the material sectors, XLB, industrial sectors, XLI, utilities, XLU, healthcare, XLV, financials, XLF, consumer staples, XLP, consumer discretionary. So remember, consumer discretionary stocks were doing very well recently, and you could trade the whole group with the XLY if you were doing that. Now, again, they kind of, I don't know. We're looking like we're still kind of maybe at the bottom of the bowl right here. We want to see the bowl start moving higher. But I could say, okay, if we can break above here, that's where I want to start buying consumer staples. We can break above that resistance area. But you can start looking at the whole group. And so once you have your watch list set up, just like I do with the market update, you can then click on the first one there, select watch list, and then select sector ETFs right there. And now I can just scroll through them all. Materials have been in a strong uptrend, although this is now looking like the Dow average. And by the way, a lot of this has followed the Dow movement pretty well. So if the Dow starts breaking down, you'll probably see the XLB sell off a little bit more. But that's looking like it's kind of going into a little bit larger correction there. But you can just scroll through these and kind of see what the different sectors are looking like. I don't do this every day or even every week, but occasionally I'll kind of jump up there and kind of go through them, see if I see anything interesting. And what I really liked was that IBB chart of biotech. And remember, one thing I pointed out is as we gone to the muscle stocks here and the new buys, we've seen a lot of these biotech stocks showing up on the new buy list. I pointed that out a couple weeks ago. We're seeing oil start to show up on this list again. We're seeing biotechs. It's not surprising at all. The software is pointing it out for us. We just have to believe what we're seeing. Now, by the way, in this new buy list, I do like this chart of rig Transocean. It's the big oil rig stuff out in the ocean, and it's trending up. Looks like it's coming out of a bullish ABC pattern right here. This big move up, bullish ABC pattern. Looks like it's on the move again today. Again, it's down a little bit today, but not by much. It's holding up pretty well. Look at a longer term chart of this. There's still some room for it to run a little bit here. I also liked in that new buy list this MAXN right here. It's a solar company. Yeah, I liked kind of this. It's got the bowl-shaped move right here, kind of a little bit of a couplet handle formation, a little bit of a correction right here. Looks like it's moving up again. Could be, though, that this is A, B, C, and it comes down a little bit further and then goes. But, you could just take this previous high right here, and if we were to break out above that, which we probably shouldn't do if the market's going to continue to sell off a little bit in the near term, that could be maybe an entry signal there. And then one last one on the new buys is this Jazz Pharmaceutical 93 strength rank. And it's been stair-stepping up pretty nicely through here. Now, you do recognize it's getting up towards some area of resistance. Let's back out and look at a little bit of a longer-term chart there. A little bit of resistance right here, but here's a previous high up here that's 170 from about what you're looking at a possible $12 move if it continues this uptrend there. That one looks pretty good. Again, another thing to look for trades is going to that sector tab. And what I usually do is I look at, typically in bull markets, I do this. You'll go to the sector tab, whatever the top, you look at the top sectors, and I like to look in the hold section because my confirmation is usually from it to get in would be for it to go from a hold to a buy. But I'll look in the buy section as well if I've got time. But in the hold section under the oil stocks, there's two coal stocks I really like. BTU, Peabody Energy right here, 99 strength rank. Now let me switch this over to signals too so we can see it. Again, even with oil selling off, this has still maintained that uptrend. And it sold off with oil, but it didn't go to a lower low right there. And if it holds that low and continues to move higher, this thing, I like the trajectory of that. And coal I think is going to be big for for Europe's energy needs because you can ship it easily. And it's cheap compared to some of the other energy sources. It's been pretty cheap. It's getting more expensive because obviously all energy is kind of rallying a little bit, but you still have some room to run, in my opinion. And then one we've been in the portfolio, I might be getting back into again once the selling is done, is Console Energy, CEIX, 99 strength rank. And again, it's held up pretty well. It's kind of held that bowl-shaped move pretty well. Hopefully this holds as a higher low right there. And then just a couple of individual ones under Industrial products. This is a steel company, MRC. We're seeing a lot of the steel companies on the move as well. But I like that kind of couplet handle formation right here. It starts to break out above this range. It could really start taking off. I probably wouldn't get in it until it breaks out above that range. It's been in that range for a month and a half. So, I don't want to get in this thing and stay, have it stay sideways for another month or so if it's going to do that. Back out and look at the longer term chart of this too. Yeah, it still looks like it has some room to run. And then I also, under mining and iron ore, I like Vale. 89 strength rate, because we're right on that border. We'd like to see it above 90, but I think it's close enough. And this is a pretty well-known mining company, but it looks like it's going through a little bit of a correction right here. It's already at a buy signal, but I like the trend of that. All right. I think I covered all the stocks. Let's take just a quick peek at market here before we take off. Yeah, we're off the lows a little bit. We'll see if that, but not enough to where it doesn't look like it still could drop. But when you see it like decline into the close, at the lows of the day into the close, you almost always gap down the next day. So that's one thing to look at. If it comes off the lows a little bit, there's a chance that maybe it tries to rally in the morning. Another thing, I'll remind you, if we are down pretty big tomorrow, markets don't tend to bottom on a Friday, so expect at least a gap down on Monday if that were to take place. Now, it doesn't always work. I had a situation that I think it was even this year where I pointed that out, and then it made the low probability move. It rallied off on Monday, but the market will make the low probability move sometimes just to keep us on our toes. So we have to recognize that. But from a probability standpoint, that's something I learned and has made me a lot of money over the years, especially with my option trading. It's almost money that's given to you over the weekend. Get in at the end of the day on Friday when it's clear you're closing down pretty big, and then it gaps down on a Monday, and you can get out right when the market opens, and you may not make a ton just if you're getting out over right when it gaps down, but it's like high probability money you get on those type of trades, just knowing that simple thing that you typically don't bottom on a Friday. All right. Have a great week, everyone. We'll see you Tuesday for the next market update, and hopefully we have a market moving far enough to have something to talk about. Have a good weekend, everyone. Bye now.